There's an ongoing argument amongst traders about the usefulness of technical analysis versus fundamental analysis. A lot of traders sit in one camp or the other. Technical analysts, of course, believe that everything that's known about a currency, a commodity, an index is reflected in that current price, and that price, when it's put on a chart, can show patterns which can be useful to traders seeking to profit from future moves. On the flip side, fundamental analysis looks at the key economic and company-specific events that can move prices. Today we'll be looking at that fundamental analysis, and one of the key movers, the changes that occurs that makes prices change in fundamentals, that is events. And then we'll look at some strategies for taking advantage of known events in fundamental analysis. There are a number of factors that change the fundamentals and therefore can change the price of a trading instrument. They include seasonality, those known events that occur each year. They include unplanned events, surprise announcements, but they also include fixed events. Those events we know are coming, we know the date and time, and we know have the potential to move a price. And it's these events we'll be focusing on today. So when we're talking about event trading, what events represent trading opportunities? Well, broadly speaking, any event that changes the price of a financial instrument is a tradable event. But we tend to break these events into micro and macro events. Micro events are specific to an instrument, a commodity or company, whereas macro events affect broadly the markets because of their broad impact on the economy. Macro events can include data releases and central bank interest rate decisions. Let's have a look at these in a bit more detail. When we're looking at micro events that affect company prices, company results are reported regularly, often quarterly, sometimes semi-annually, and annual reports can be very important, not only for the numbers that they produce, but the outlook of the management and their projections for the future. And this, of course, can affect the share price underlying. We also have regular market events like option expiries, and where options have been very active, that expiry day can affect the price of the shares. Changes in substantial shareholdings can be very important to company prices, where a well-known shareholder has been acquiring more shares. That can spur buying in itself. If a large shareholder has been divesting themselves of shares, that can also spur further selling. So shareholder notices are another tradable event. And of course, the big one that so many CFD traders look out for, mergers and acquisitions, and in particular takeover bids. And when we're seeing takeover bids in the market at 20, 30 or 40% premiums to current market prices, the potential impact on trading can be very significant. But commodities too can be affected by micro events. We regularly see reports on inventories and stockpiles in specific commodities. And of course, this can change the view of the market. An example is the regular reporting of US crude oil and refined products each Wednesday. And where inventories are much larger than expected or smaller than expected, this can have a direct impact on the price and therefore is a trading event. We also see market-related events. Futures markets around the globe often report on the open positions in the futures markets over commodities. And some exchanges will break these down into trade exposures and speculative exposures, giving insight into the composition of the market and what's been driving activity. And of course, the release of this information can also have a major impact on prices and is therefore a trading opportunity. Turning to macro events, we're looking at the events that affect broad economies or even the globe. Now, we see regular events like data releases. We know, for example, when most countries will report their gross domestic product. And of course, markets focus on these to determine whether or not an economy is growing or not. Employment is also a key indicator of the health of an economy and the growth potential within that economy. Markets tend to focus on inflation readings, whether consumer prices or producer prices, because we know that central banks around the globe have at the centre of their mandate an inflation watch. And we also regularly receive sectoral information, housing data, retail trade figures, industrial production numbers, manufacturing indices and services indices that can change the way investors and traders view a market. And so all of these events can represent trading opportunities. But of course, the great movers of markets, the central banks, also can provide events that change the price of currencies, commodities, indices and shares. At the moment, non-conventional policy or quantitative easing is one of the key drivers of asset prices, and so any announcements around intentions for quantitative easing can be very important to markets and represent trading opportunities. When central banks change their interest rates, they change the economic environment. Also an important event. The testimony and the statements that come from central bank meetings detect any shift in the stance of the central bank. Another event that can represent a trading opportunity is when central banks intervene in currency markets, as the Bank of Japan and the Swiss National Bank have done. And whether or not we go with the central bank or against it, it's that intervention, that event in the market that represents a trading opportunity. The challenge facing event traders is that when an event occurs that affects the price of a currency, a commodity, a company or an index, the reaction in the market can be very sharp. It can start moving very rapidly, and that can make it difficult to get into the market once it's started moving. Luckily on the CMC platform, there's a tool available to help event traders in just this scenario. It's known as a stop entry order, and essentially before the event we can place an order to sell below market or buy above market in anticipation of a move in that direction. Let's look at a hypothetical example. Let's imagine that the Bank of England is about to make an announcement on its monetary policy. Recent low inflation readings have the market speculating that not only might there be a rate cut, but there might be a monetary stimulus, an injection of funds into the system. And if there's both a rate cut and an injection of funds, it's quite likely that sterling will fall. On the other hand, given the market speculation, if there's no rate cut, and no change in the stimulus policies, we could see sterling rise. And a trader can use stop entry orders to prepare for both eventualities. Here's our chart of sterling versus the US dollar. And we start to enter our orders in the way we'd enter any order. We'll start by entering a buy order above market. We click on the buy button, which brings up the ticket. When we put in an amount and hit enter, you'll see the price window open. Now, we change the button here from market to limit. Remembering this is our buy above market order, we're going to put an entry to buy at 157.20, about 23 pips above the current market. We can also put in a stop loss order and a take profit order to go with it. And as any of you who've seen our other videos would know, I'd recommend attaching a stop loss order to every order. But having done so, we'd then hit the confirm button and double confirm it. And you can see in the account section down here, under the orders tab, the order appears. A stop entry buy in sterling versus the US dollar for 500,000 at 157.20. To enter a sell order, we do exactly the same thing on the sell button. We bring up the normal order ticket, place in an amount and hit enter. We then change the price from market to limit order. And once again, if we do see a rate cut and if we see stimulus with it, it's very likely sterling will fall. And so we put in our sell entry order below market in anticipation of that sell reaction. We add a stop loss and possibly a take profit, hit confirm again, and there we can see in the orders window a stop entry sell order for £500,000 at 156.70. So at 50 points, or roughly 25 points either side of market, we now have an order that will be triggered should sterling make a move on the announcement. The stop entry order, a key tool for event trading.